and good morning, listeners. It's the final day of trading for the week, and this is Almus Market Mornings with me, Shikhar Garg. So, we had the BOE meeting yesterday, which concluded two things, of which one has raised significant credibility issues for the central bank. Firstly, they raised rates by 25 basis points, which was widely expected by the market participants. But the sudden disappearance of this recession possibility raised many eyebrows. Last November, the central bank warned of a possible recession even with the rates at 3%, and now at 4.5%, the bank expects the economy to avoid recession currently. On the domestic front, India's inflation is expected to be on the weakest side in 18 months for the month of April, according to surveys, being in the band of 2 to 6%, or rather towards the middle of the band, according to the surveys. A pause by the Indian central banks was also in sync with the global central bank's pivotal actions. Interestingly, though, we saw the commodities cratering yesterday. So, JK, what are your thoughts on all these, the commodity action, the domestic market, and the international market?
Good morning, Shikhar. It was a day that one would have considered as a day of bad news being good news, but for the fact that there was fresh tensions on the banking shares, which actually led to a risk averse scenario, and we had stock index falling, across the markets, and also banking shares themselves were banking index itself was down by 2%, and also lingering worries about Chinese economy. Otherwise, the headline PPI and core inflation both falling more than expected would have been welcome for the markets, and also a sober picture of the economy as depicted by weekly jobless claims rising to 2,64,000, highest since October 21, as against 4 lakh, forecast of 2,45,000. So actually, the above reports suggested that the demand was slowing, unemployment was increasing, and they raised risks of recession later. At the same time, possibly strengthened case for pause in the month of June to be followed by perhaps some rate cut later in the year if the trend was kept up. Now, immediate reaction of these data was, as one would expect, a fall in yields across tenors, although they recovered towards a close, only marginally lower than what it was previous day. The recovery needs should be tied to increased concerns about unresolved debt ceiling, which has pushed up a shorter tenor T bills yield to multi-year highs. In fact, some large investment bankers have expressed a view to avoid buying treasuries in these conditions. The slowing job markets portending a possible recession, concerns on debt ceiling stalemate, and banking index seeing fresh fall triggered fresh outflow of deposits from the small banks. Debt equities falling, particularly in Dow and S&P, while Nasdaq registered a small rise. As things are getting increasingly uncertain, investors are seeing risk averse, and more falls in risk assets can be expected. On the Fed speak, of course, it did not help matters because the Minneapolis Fed President Neil Kashkari said inflation has come down, but it is still well above the 2% target. And there is some evidence that it is coming down, but so far it has been quite persistence, and that means we are going to keep it at an extended period of time. And if inflation is going to stay high and it's embedded in the economy, we have to run tight monetary policy and an inverted yield curve for an extended period of time. That creates real problems for banks of all sizes. So that really also did not help the stock indices or the risk assets. On the debt ceiling itself, the meeting between President Biden and top lawmakers had been scheduled for Friday, and that was postponed. And the leaders agreed to meet next week. But reportedly, this is not a sign of trouble, and even stated that aides from both sides have started to discuss ways to limit federal spending. As talks of raising the government 31.4 trillion debt ceiling near the maturity, and the near maturity treasury bill continues to inch up in their yields, reflecting concerns about consequences of a no deal being stuck in time. And we did have China concerns rising. There is more room to his policy in China as as a fine tuning in the form of lower reserve requirements and possibly a cut in benchmark rate. This is after disappointing trade numbers as well as a very low inflation number, or should we say disinflation. So even as a slump in China bank loans and prices raise worries about recovery, and that adds pressure on the central bank to ease policy further. As far as the uh, Bank of England is concerned, the move to hike rates was a very well expected one, but they, surprisingly, as I said, they actually raised the growth prospects for the economy, and now the GDP is expected to be flat over the first half of this year and growing by 0.9% by middle of 2024 and 0.7% by 2025. And all this is much of an upgrade from what they had forecast earlier. At the same time, inflation is forecast to decline sharply from April, while extension of government's energy price guarantee and further fall in wholesale energy prices also are set to remove some of the inflationary pressures. So they are now painting actually a kind of good scenario for the market, or rather the economy, which was absent some time back, and that is really raises the questions as to the credibility of their forecasts earlier. And as far as the dollar is concerned, risk-averse conditions led to safe haven demand, further aided by its oversold status. Also, while some rethinking seemed about rate cuts being anticipated with the market, there is a sense that any further rate hikes from Europe might be more modest than previously thought. So actually there is some things are moving somewhat in favor of the dollar, and as far as the rates are concerned, unlike what we saw in the previous day, dollar was strong against most of the currencies, and euro fell through another support rate to 1.0940, and possibly headed towards 1.0880 at least. Sterling fell despite BOE's rate hike and positive comments about the economy, as profit taking set in, along with influence of the general strength of the dollar. Yen was in demand as a safe haven, although it has once again retreated with some retracement in the yields as well. Yuan continues to weaken, and technical picture shows that it's a matter of time before we hit the 7.00 mark. And overall, we carry a positive view on the dollar in the short term, as market positioning looks heavily short and news from other economies start to get worse. Looking ahead into the calendar, we have more clues on inflation and economic outlook when Michigan preliminary survey results are announced. We would also be keenly watching comments from James Bullard, the non-voting Fed member, who would be discussing monetary policy before a conference at Stanford University. Just to highlight a few things which are happening in the market as an extreme, USD against South African Rand almost hit an all-time high at 1940 as the economy continued to struggle due to ever-present power shortages. And on a day when there was a deep risk of sentiment globally, Turkey stocks had a banner-up day by rising as much as 8% as a presidential election candidate. One of them actually withdrew from the contest, making it easy for the current ruler to come back into power. On the rupee side, rupee managed to stay above 82 amid the global factors influence. As far as the flows are concerned, there is no major inflows or outflows, except that whenever there was a dip, we did see the nationalized banks coming and buying, and having closed above 82, and then possibly 82.10 being taken out, we will head towards 82.25, which is the next resistance. It looks like we have resistance at every 15-20 paisa until we hit 82.50 or break it. Till then, I think rupees movements are going to be very slow and grinding. Have a nice weekend. Thank you.
Okay, JK, that was quite good. And yes, the fresh tensions on the banking side has kept a lot of indices on the check, as well as market participants on the caution side. But what's quite interesting to see is the insurance or the CDS for the US default are rising. But would that happen? I mean, that's something only time should tell. But it's quite interesting to watch being something like this discounted amongst the market participants, and it's an encore of what happened a few years ago. So there's going to be a lot of historical playbooks coming out. Apart from that, we've seen some sort of risk averse conditions coming in, and that led to the safe haven demand, which kind of is observed with the dollar strength in the markets. Even the South African rand, as JK mentioned, has reached an almost all-time high, hovering around 19.18 right now. Quite interesting set of moves is being observed for the domestic market. Yes, USD INR went higher, and as JK mentioned, there are multiple levels of resistances that can be observed, while the central bank also has been active in the markets in managing the volatility. So it's something that we should observe over a period of time how the currency pair should behave. But before I close for the weekend, instead of saying TDIF this time, I'd like to mention a quote. I don't really remember well, but I heard it yesterday, and it's about being the slaves of schedule. Now we have become somewhat a slave of schedule. So I hope this weekend you guys set yourself free and do something apart from your schedule to make the lives a bit more easier and good. That's it for today, folks. Thank you so much for listening, and we shall come back again next Monday for another round of updates. Thank you.